Okay, sorry about the delay, technical difficulties. Make this one quick today. My name is Scott Smith. I'm a senior technical analyst here at Briefing.com for the last 10 years or so. I post a series of columns under Blue Chip Trader under the Briefing Trader service. And today's webinar is going to be focused on turning profitable day trades into winning swing trades. And to start off, I want to define what day trading and swing trading are. These are in my own terms. These aren't textbook terms, so this is how I define them. This is how I approach the market. And hopefully I'll give you some bits of information and nuggets of trading tips that you can kind of adapt into your own style. So basically when you day trade, you're trying to take advantage of short-term price fluctuations, whether that be intraday or overnight. And the typical day trader will go in with relatively large size, with a really tight stop, and they're really just trying to capture that that intraday fluctuation for a small gain of sorts. And the mentality there is usually I'm going all in for say 1,000, 2,000, 3,000 shares, but I'm also getting all out when I make 20 to 50 cents, of that position. They're always looking for some sort of edge before they can jump in. And then over time, they assume that those small gains should add up to much larger gains. When it comes to swing trading, it's a little bit more about positioning yourself within the momentum or at a particular support and resistance level and trying to capture and sit with that position for a couple days to a couple weeks. The longer the better. Usually people don't go in with a full-size position, much like a couple thousand shares. You're going to go into something a little bit smaller and medium, and you're going to have a much wider stop because you recognize that in order to be in this position for 3 days to 3 weeks, you have to give the market some time to work itself out. You have to give time for the patterns to play out. I like to use the term time and space. You have to just allow the market to go through its normal fluctuations. So you're a little bit more lenient with a lot of your positions in swing trading. It is definitely, some people take an approach of scaling in and scaling out, which means incrementally increasing your size as the position is working in your favor, or maybe adding to it a little bit if you still feel confident in the position. And then as it starts to work in your favor, you're going to take a little bit off here and a little bit off there. The whole concept behind here and the whole objective is that you're trying to look for a steady flow of medium to bigger gains as opposed to small gains consistently that are adding up. You just want a constant steady flow of medium-sized gains, and eventually you're going to have one that turns into a much bigger gain. The way I approach most of my trading activity, and even on the Briefing Trader service, is I kind of take a combination of these things, and I'm going to show you a few examples of what I mean. Before I do that, I do want to say that there are 3 key components to consistent success in trading, and these are a staple of how I approach every single one of my trades. First off is partial profits. I always want to put money into my account. The more cash that I have in my account, the more I'm going to be able to take advantage of the next opportunity that arises. Trailing stops. Once I have a profit and I'm starting to take money off the table, I always want to keep a small position on, just in case that stock, rockets higher, over the next 2 days or a couple of weeks. I always want to make sure that I'm trailing a loose stop somewhere behind it, even no matter how small the position is. The last thing I want to do is have a position just go up, $2, get out completely, and then watch it go up another $30 over the next 3 weeks and not be actively, taking advantage of that. And then the third component, which is crucial to just any sort of long-term success, is preservation of capital. Very, very rarely do I hold a losing position overnight, long or short. If it's a loser, and it's beyond my initial risk that I established for the stock, I'm usually going to take the loss unless I'm somehow hedged against it with an option or some other short position. This next screen down here below, I did want to show, just a quick example. Say you're trading 300 shares, right? So the day trader would actually go in full 300 shares and out 300 shares if they made $1, and they would make $300. And what I usually try to do, there's different methodologies of, actually how to manage the position once you're in it. And using this first one right here, if you're up $1, you can sell the bulk of your position. And so in this case, it would be 200 shares for $200. And then when it goes up to $2, you can sell the last remaining 100 shares for a $200 gain and get a gain of 400. If you were long 300, you could sell a smaller position when it goes up only $1, and you would basically get $100. And then when it goes up 2, you would sell the remaining bulk of your shares for a total of $400 for a gain of 500. So just looking at this, some people right off the bat would say, well, obviously you want to do this. You want to sell smaller increments as initially, and then sell out the bulk ahead of time, which is totally fine. If that's your comfort level, that is completely fine to do. You kind of have to do what you're comfortable in doing, in the market. I'm just going to show you the different types of scenarios of how to manage a position here. And then the one that I usually follow and the one that I really advocate on the site is that if I was long 300 shares, I'm just going to sell 100 shares at a up 1. When it goes up 2, I'm going to sell another 100 shares for $200. My total gain is $300 on the day. I will tighten up my stop loss on the remaining 100 shares, but I'm going to let that ride with a trailing stop for as long as the position continues to work in my favor. And that gain of 100 shares, it's something that I don't have to worry about. It's hopefully the market moves in my favor, and I can make $1,600 on as the market just trends higher. I really personally I like that approach a lot because it frees up a lot of my capital and allows me to jump on the next opportunity when I see it. So I'm just going to move forward. Now, identifying high probability setups. This was taught to me a long time ago that the best day trading opportunities are always going to be looking like really, really good swing trading opportunities as well. And again, I'm going to show you about 4 or 5 examples in a few minutes, but just keep that in the back of your mind. You don't always want to just trade a stock just because it's there. You don't want to just look at a chart and say, okay, it's kind of an inside day, it might be an outside day, there might be a hammer, it might be along a 50-day moving average. You kind of want to sit there and say to yourself first, would this make a good swing trade? Once I identify if this will make a good swing trade, long or short, then I'm going to start looking at the potential day trading entry point to turn it into a swing trade. And you'll see what I mean in a few examples. For those of you that are martial arts fans, I found this quote by Bruce Lee, and I think it's really key on the psychological component of trading. And the bottom line is that you have to be like water. And what he was saying is that when he confronts an opponent in a fight, no matter all the training that you had, you teach you how to punch or kick or do your certain move, it's never really going to play out the way that you trained for. Your opponent's always going to throw a curveball at you. There's always going to be a dodge or something else, and you're going to have to constantly adjust to your opponent's stance or the way that they attack you first or the way that they defend one of your moves. You have to be pretty much loose and open and just go with the flow. And I think if you approach the market like that every single day, you're going to be more successful. I'm not saying to not do your homework every night. I mean, you have to have some sort of opinion. You have to look at the charts and establish, some sort of bias for the day. But I would say 50% of the time, when I have a pre-market bias of knowing if I want to go short or long for the day, the market is so fluid, and within an hour, things will start setting up and things will start moving, and I have to change my whole game plan that I had in the morning that I was planning on doing for the day. I'll start adjusting here and there just to take advantage of what's developing as it goes on. And I think if you kind of have to take that loose approach when you are short-term trading. One of the things that really helps me to take on that approach is that I tend to focus more on zones, areas, and different levels of support and resistance. I don't try to nail the market down to the exact penny. I understand that I'm kind of old school. I was started in this market when we used to trade in 8s when everything was 12.5 cents. So to be trading on a penny or a nickel or even a dime, It just doesn't make too much sense in my mind. I'm always trading for something bigger than an eighth, let's say. So I tend to look at a lot of my comments on the site and a lot of my trading. I look at the dollar increments itself, and I try to look at 50-cent levels, and I really don't go anything shorter than a quarter when I want to actually approach a particular trade. And I find that help is very, very helpful. Because it gives me that extra leeway that comes back to this whole allowing the market, giving it the room that it needs to work out in your favor. If you're a day trader, like I said, you're going to go in hard, and you really have your margin for error is so small, so high actually, that it's just you have to be almost perfect in order to get in and out at the exact time. But if you approach it with a more general, loose area and you say, hey, I really like this area down here, let me start scaling in small around this particular zone. I think there's going to be a reversal, or let me see the market action actually reverse from this zone, and then I'll start adding to a position. You're going to find out that you're going to have a lot more patience. You're not going to have to sit there on the edge of your seat all day long, and you're going to be just a little bit more lenient and more patient for letting your winners run. And that's really what this whole webinar is about, is when you get into a really good trade and you start taking a profit off the table, you want to sit there and let your winner run into a much larger gain. Of course, if you do get into a position and it starts to fail on you completely and it goes beyond your risk level, cutting losses again is a huge component. I'm a big believer that if you do carry a losing position overnight, it becomes an opportunity cost that's going to consume your time, energy, and capital the next morning. Your focus is going to be on managing a loss as opposed to managing a winner, and you're going to miss out on opportunities that are going to be presenting themselves. So just something to think about going forward. All right, to the example section. So I'm just going to go through a couple trades that I took over the last few weeks and why I took them. So again, the concept here that I want to drive home is the best swing trade, the best setups for swing trades usually are where you want to be focused on for day trades and vice versa. So in this example of Amazon, the stock was getting hit pretty hard during the August correction, and it came down to the 100-day moving average, which is the green line right there. It was a 50% retracement off the May low and the August peak, and it also had these June highs in place right here. And the theory of old resistance becomes new support. There was also a RSI positive divergence that brought it up to my attention, and I believe on the TA page scans, the stock was down 3 days in a row. It was an oversold candidate at the time. So right off the bat, when I came in on, I believe it was August 29th, I was looking for some sort of opportunity to buy this stock around the 279, 280 area. August 29th, about 15 minutes after the opening, I threw out Amazon as a bounce candidate out there. And here's the 5-minute chart that I was looking at. I would also advise, too, if you are day trading or swing trading, you should not be looking at just a one-day 5-minute chart. Your chart should pretty much expand a minimum of 2 to 3 days, possibly even a week's worth of activity, even on the smaller time frames. And the main reason to do that is that it's going to put everything into context. If you're focused too much on an intraday chart, on a one-day chart, you're just going to be so caught up in in all the noise that happens that you're going to constantly miss out on what's actually happening over the last few days. So with that in mind, on the 29th, the reason why I put out the long trade was, first, I like the area. I like the 279, 282, 283 vicinity. And I was looking for some sort of intraday reversal for a signal to get long. And if you see, the stock actually opened down, it traded down to 280, and then it reversed back above the previous day's close, and went into positive territory over the 282 level. So I wrote it up, and we jumped on board around 282.75. Now there was resistance here, but again, take it into context that it had traded down pretty hard over the 3-day period, and it was holding at this key support level. I figured that there was at least a chance that it would get back to the gap zone, 285, 286, that happened 2 days earlier. Unfortunately, within the next hour or so, it did get back up there, so we had a nice little gain of about about $3 to $4 to take advantage of there. Now, in something like that, once it gets to a particular target, this is where I will take off a partial profit of $3 or $4, and then I raise all my stops. If I was risking, the lows here at 280, I'm going to raise everything up to break-even area, probably, or somewhere around the opening. I'm always willing to take a position off, have it come back in, retest where my entry point, and then see if it takes off again. You always want to kind of keep it just a little bit lower, and then yeah, you're going to give up some profits. I mean, that's part of the game. But as long as it doesn't start eating away at all of your partial profits that you took, well, then you should overall come out as a winner. Unfortunately, what happened here the next day, I did hold this position overnight, by the way, because it did close at 284, which was a good $1.50 or so above my entry point. The next day, it traded all the way back down to 280, took me out of the position, and then the following day, I think it closed on 280 that day, and then the following day, it actually gapped up over 285, 286, and just took off from there. You can see on this chart here, this down bar here, that was my stop out, got me out, and then when it just gapped up over 285, I wasn't ready to chase it at the beginning of the month there. But ideally, I would have had some sort of looser position on, and I would have been, this is where the best day trades are going to turn into the very profitable swing trades if you get in at the right zones. And had I managed that trade properly, I would have caught this entire extension up for a really nice swing trade all the way back up to the $300 level. So that's an example. I'm not the perfect trader in the world. I definitely make mistakes and errors, but I know what I'm doing and I know how I want to manage a position going forward. So Apple is another great example. I actually picked up this one yesterday on the trading service, and lo and behold, this is actually a very similar setup to the Amazon trade that I took at the end of August. The green line is the 100-day moving average. Price came down pretty aggressively over the course of about 3 or 4 days. It was an oversold candidate on our TA scans, and a 50% retracement was in effect off the July low and the August high. There were also RSI 5, and I'm sure stochastics or whatever else was getting pretty oversold, and it looked like there was a chance that it was going to be some sort of bouncing activity going on. And for an entry, I was kind of looking for a move where we would initially thrust lower and then reverse higher. And that's what an opening reversal is, for those of you that don't know, is it's where the market will actually thrust one way off the opening. Usually it takes out a prior high or a prior low, gets rid of those stop orders, and then will completely reverse, go back through the prior day's close back into positive territory. And whenever I see those type of plays, I know I usually want to jump aboard, especially when it's in a high probability zone of where I know it's going to, where swing trading capability is setting up. So in this case here, we did have this very quick opening reversal on the first 5-minute bar. We suggested getting long around 151.25. About an hour and a half later, we were already back up at the prior day's opening range, and we recommended a partial profit of 7 points. If you were trading options, I believe they were trading around the October calls, 450 calls are around $16, and they would trade it up to about 19 by this time. So that was also, you can also apply all this to options as well on higher price stocks. So we recommended taking a partial there, and then you can see it just kind of closed out pretty favorable. I would actually have to see it come all the way back down to my break-even point to just start looking at it again to see if I should be getting out of the balance. As long as it closes with a significant cushion, I don't personally see this day trade to to close it out into the close. Whenever I have a large cushion, I'm always willing to sacrifice. I'm taking a partial, but I'm always going to be willing to sacrifice something, the next day, just to take advantage of if there's another push higher. Unfortunately, we did hold it overnight, and this morning it gapped up right to this 264, 265 gap resistance zone from 2 days ago, and we were able to tack on about a $13 to $15 gain for another partial profit. And I'm still holding the final balance of this because I took 3 contracts, and I sold out the first one here for 7, sold that one this morning at the opening for $13, $14 gain, and I'm still holding on to the other one because it's still well above my entry point, and it's closed this gap. And now I'm looking at the next gap, 475, and the 20-period moving average as my next target level. So again, this is a perfect example of why your best day trades are going to be best suited to hold overnight if they're in a good swing position. So for example, just if I was to take like a day trade, say over here back in mid-August on this inside bar, that's not really an ideal opportunity that I want to be holding a swing. Not short or long in this regard. It's just a really difficult read, especially when you have an inside bar, or even if you took it on this day here. Holding a day trade here, even if it's profitable overnight, is just a tough position. This is not an ideal swing trading entry point up here around 500 level. Something closer to here around about a week later, the 20-period moving average would have been more ideal to hold for a swing. Down here at the 100 period, definitely. Down here at the 50, definitely. So that's basically what I want you to try to look at the chart for in the daily. Look for swing trading opportunities, like along key support resistance areas, and then try to focus on the day trading opportunities that are there. Another great example that we had back in early August, I was turning pretty bearish on the retail sector. It was actually making new highs in late July, early August. You can look at a chart of RTH or XRT. Those are two retail ETFs, and they were making new highs, and they were just completely overbought. Their RSIs were well over 70. There was just a whole bunch of signs that they were showing up on all of my overbought scans. And so when I thought there was going to be some sort of correction coming into early August, I wound up looking at some of the laggards in the group, and Macy's is one that showed up. It was a definite laggard because it wasn't making a new high. It was still trading below its July high, and it was also trading below its May high as well. And it was taking on this bear flag formation. Once the market started to correct on August 6th and it started falling out of this bear flag pattern, that's when I suggested to get short around 48.50. It was already down about $1, which seemed pretty steep, but if you can see, it went down to about 47.75 for a 75-cent gain, which is a great day trade. It's a 75-cent gain for your initial position. It closed, started breaking down below the 20-period moving average, below the 50-period moving average. And then the next day, it actually went down, looks like another 75 cents or more. So again, that's an excellent opportunity to lock in some profits. But since it's a winner, and because it's an excellent swing entry out of a bear flag, and the whole group was overbought, and this was a laggard, and it was below the 50-day moving averages, I was not inclined to get rid of the entire position. I wanted to keep a minimum, a third or a quarter of this position on for a bigger picture swing. And I basically put my stop loss up around the 49 area, and I just wanted to let it ride. So even though it went up 1 or 2 days later, it struggled with the 50-day moving average, I still had this position pretty small, after taking 2 profits already, but it was still sitting there as a swing at around the 49 area. And like I said earlier, I'm a big advocate of that because I freed up some cash, I put money in my account, and it kind of just sat there and waited out to see if it was going to turn to something bigger. And my initial target for this was definitely coming down to like the 46 area here, especially with the market rolling over. Fortunately, earnings came out, and the stock gapped down on August 13th or 14th. And again, you could have taken another partial profit there at that point. I chose to just sit there and just kind of let it ride out and watch it go all the way down to the 200-day moving average for about a 5-point gain. I am still holding a very small position just because it doesn't seem to be acting really well. It's actually still lagging behind a lot of those other retail ETFs and retail sectors. So I'm just kind of holding it with my short position, probably around the 50-day moving average. If it starts getting around 46, 47, I'll probably look to cover. But hopefully you understand, again, this was an excellent swing trading setup. A bear flag, a laggard in the group, started to break down. That's the kind of place where you want to be focused on for day trades. because they're going to turn into something much, much bigger. Next example would be Apache. This is another one that I took in mid-August, and this showed up on the TA Scans oversold list as well. It got hit really hard for about 4 or 5 days, and it was extending below its lower Bollinger Bands. RSI 14 was in the oversold area, and then I slapped a Fibonacci retracement on the lowest low and the highest high of the last move, and sure enough, the 62% retracement was right here in play, around 75%. So I immediately had it on my radar, going into the next day as a stock that I wanted to focus on for a swing bounce, but I wanted to see if it also was set up as a good day trading opportunity as well. So what I waited for on August 20th, here's this opening reversal pattern. So again, the opening reversal that I was looking for was some sort of thrust lower that reversed back into positive territory and back above the day's open, back above the prior day's close, to signal a long entry. It doesn't. Also, I just want to point out, you don't always need to see the prior day's low taken out. I really like it when it does, because it tells me that it's like a shakeout move. I used to work on the floor of the New York Stock Exchange with the specialists, and this was just a known trick. A floor trick was to just take out all the stop orders right below the prior day's low or the prior day's high, and suck up all those trades, take the opposite side of them. While they're selling out, you're buying into it, and you've already established yourself to just lift the stock higher. I can't do that because you can't. If the stops get taken out and they reverse, that's great, but I always want to see it go into positive territory. Once I see it go into positive territory, I know that it's going to be showing up on a lot more people's radar screens in the green or whatever their colors are, and it's going to start attracting more buyers. Usually when stocks are red, you're not going to see too many buyers. When the stocks are green, you're going to see that this shows the mentality there is that there's buying going on. So we jumped aboard right around the 76 level on this opening reversal. I was looking for a much bigger move, so when it did get up to $1 at 77, it briefly tagged it. I wasn't looking for an entry, but again, this was an excellent day trade. Say if you jumped in with big size, you could have easily taken $1 off right around here. Usually on these types of moves, I try to get something closer to the prior day's opening range, and so that's one of the reasons why I also didn't take it and take a partial profit so soon. The other reason I didn't take a partial profit so soon was because of the extent of the drop. The stock was down about 82 to 73. It's down almost 10 points in about 3 or 4 days. I wasn't ready to take a $1 gain. I was definitely looking for something well over $1 or more. So it closed profitable in our favor by about 50 cents or so. And because of our excellent entry point and our risk was down here around 75, I was definitely willing to carry it overnight. The next morning, we see price went higher. We had a much stronger thrust over 77 here, and that's when I back into this opening range area, and that's where I recommended taking off over $1.25 profit. It closed again favorable in our favor, and I still maintained about 2/3 of position. And then the next day, it gapped up, or traded up strong again at the opening, getting back into this gap zone here, and we were locking in about a $3 profit by midday. By that time, I already, it did go up the next day over $80, so there was also $4 partial gains to lock in if you had it. Now, once I had that one, at that point, we were already up, approximately $4. The rest is gravy. I mean, I had maybe 100 shares on at the time at 76, and that was left over. And, I was just going to leave the stop at break even. There was no reason for me to tighten up to the prior day's lows or panic out of this next day's gap down on some overt news, probably, geopolitical headlines or whatever. You always wanted to see how it played out, especially since I had such almost a $2 cushion, $4 cushion to work with. So I'm always willing to keep on. I've already freed up enough capital for the next opportunity. There's no reason for me to start panicking out about a one-day gap down. If it starts selling off hard and the volume started increasing above average, I'd be way more inclined to then get out and salvage whatever I can on the trade, maybe $1.50, or just get out break even on the balance. But for the most part, I just saw this as a position that I should just be holding on to, a small piece. Unfortunately, 4 days later, there was news that they sold off a piece of their company, and the stock gapped up nearly $8 to the 85 level. And if you were holding more than 100 shares, or even if you were holding 100 shares, take a $50 profit into a gap up. Anytime I see a gap up or a spike, that's a gift. You always want to trim something into those big, large gaps. And I'm still holding a very small position, an odd lot actually, just grinding higher here. Just got the nice trend line here. I believe there's an 8-day moving average or 10-day moving average that's just riding higher here. For a nice gain of about $12 on my remaining balance. And again, this started out as a day trade with full size, and I took profits along the way, and now it's this $12 gain on a swing trade. Granted, the position's smaller, but I had no clue that it was going to gap up higher here. You just kind of have to go with the flow. Like I said earlier, you have to be like water and give what the market's taking you. But you also want to manage your risk, and you want to put money in the bank. I mean, this is short-term trading activity. This isn't investing. If you're investing, it's a totally different game. But this is day trading and turning them into profitable swing trades. I'm going to just fly through some of these real quick. So I did have another short in the financials, and this was another group that I thought was very overbought end of July and going into August looking for a correction. And I wound up taking a short here around 78, I believe it was, the first time around, and made a nice little profit of about $5 over the course of the next few days. And once I had this, again, I was bearish going into August, and I was already carrying a small position going into August short after a $5 gain because I pretty much picked off the top here on that day at around 78. And when I didn't add to it into strength here because I was a little bit nervous, but once I saw it rolling over on August 6th, I started adding to the short position again just below 75. And so once it broke below the 20-period moving average, I knew I had a just better opportunity to just sit with this trade. And sure enough, it just started tanking on us. Took partial profits down here on the bigger drops. Just sat with my balance and just let it ride below the 20-period moving average. Did take more off down here for over a $10 gain. And then finally, when it started getting back above the 20-period moving average and gapped up to the 50s, we had to start covering the position. And then gapped up again. If you weren't out by then at the 50-day moving averages, you had to get out on the gap ups. Another recent trade that I took was Schlumberger SLB Long. Basically, this is just a nice tight consolidation over the month of August. That alone was relative strength based upon the market. I was bullish on the XLE and the OIH and the XOP ETFs. They had some really nice setups there. Another key thing to watch is the 20-period moving averages. Every time it dipped below it, it closed strong above it. Dip below it, close strong above it. Dip below, strong above. Dip below, strong above. That's excellent accumulation signs. You always want to see that on stocks, especially when they're holding up overall with relative strength. If you can't see that, pay attention to the RSI 14. It correlates very well with the 20-period moving average, and as long as the RSI 14 is tagging the midpoint at 50 and going back up, and tagging the midpoint at 50 going back up, it's usually a sign that there's some sort of accumulation pattern going on. But I wasn't long yet. I was watching this and I was waiting for the breakout, and then going into September, I was still kind of this bearish framework in my mind. And I wasn't sure if I really wanted to be participating on the long side. There was just too many things going on with Syria, too many things with the Fed. There was the sell Rosh Hashanah coming up. It was Labor Day weekend. But then, sure enough, the stock started breaking out and moving higher, and I just jumped on board the breakout over 83.25. It could have been a day trade for about a 75-cent gain, and I don't think I got my partial of $1 on that day. But it closed strong in our favor above 84. So I just had to hold it overnight. The next day, it just opened up higher, took my partial off the opening, and then it was just a matter of managing the position from there. Again, I wasn't going to panic out of a lower low by any means, just because I knew this was a sign of accumulation, and I knew I wanted to stick with the trade for as long as possible. But as it started going up $2 in my favor, you've scaled out a little bit more, consolidated, and broke out again up to 88, and I think it went over 89 today, extended higher, which I took another partial profit of. So it was just a nice $6 gain here, $5 to $6 gain over the last week and a half or so on a nice breakout swing. That's pretty much it. Hopefully, again, I just wanted to summarize a few of the trades that I took on the service over the last few weeks and how I approach them. Again, I'm using classic technical analysis techniques. I'm not trying to reinvent the wheel here at all. But I think the key thing I want to emphasize is, again, focus on zones and areas. If you focus on a 5-minute chart and you're looking for that one tick, there's just way too much noise going on. You need to be focused on a multi-day chart. Even if it's a 5-minute chart, you should be looking at a 3 to 4 or 5 day time frame, and try to put that in context of where the price action is occurring. You should have a daily chart open. You should even have a weekly chart open. Put everything in context of a zone, of an area, of where you want to get active, of where you want to be interested, of where you want to participate with this, with the move. And then once you identify a zone, you then want to be focused on the shorter time frames and just look for signs that are confirming whether you should be long or short the stock. And by doing that, like I said earlier, it just gives you so much more patience and to sit with the trade and to focus on the time and space provided. And then as it starts to move in your favor, you scale out. I am not a big fan of closing. If a stock closes in my position by more than $1 or by greater than my risk, and I've already banked some profits, I am a huge proponent of holding the position overnight. I am willing to give up the next day if it comes flying back in. I am willing to get a scratch in the trade. It's just the way that I'm always looking for letting my winners run. And I've noticed that by just scaling out just a little bit or scaling out a chunk of my my day trade and holding on to something behind me, there's always going to be an opportunity for just much larger gains. Obviously, if cutting losses is absolutely critical, if you enter a day trade and it goes and you say you were risking $1 or 50 cents or whatever, and it goes beyond that level, you need to get out. Obviously, your theory was wrong, regardless of whether you were in the right zone. Your timing was off. You can keep looking at it, but you need to cut that loss before it turns into something bigger and becomes an opportunity cost, taking away from the next opportunity that's going to arise soon after. And trust me, there's always another opportunity. And just to wrap up the webinar, I do want to leave you with one thing. I have a friend who, back in 2002 and 2003, he bought about 2,000 shares of Apple. I think it was trading around $5 at the time. This is before it came out with the iPod and everything else. And he loves picking up like beaten down stocks in single digits. So he picked up about 2,000 shares of Apple around $5. He wrote it out probably to about I'd say 20. And he got out of everything around 20. By that time, he thought the whole world was too bullish on it. And it's funny. I don't think he ever jumped back in and traded it ever again for the next 5 to 6 years. And it went as high as $700. And even when I talk with him, I'm like, why did you not keep on 100 shares? It makes no sense in my mind that he didn't keep on just a small little position. When you go in with size and something works in your favor, even if you're a day trader and you trade 1,000 shares or 3,000 shares at a time, and then you get out, why not just leave 100 shares on? Just for the heck of it. See if it turns into something else. You can always move it out of your short-term trading account and put it into an investment account, or move it into your IRA, or just move the money somewhere else and allocate it somewhere else. As a longer-term investment. Just something to think about. So hopefully you got something out of this webinar. And there's not going to be a Q&A. There was technical difficulties, and I'm running kind of short on time. So, but if you do have any questions, you can definitely send them to my email at swingtrader@briefing.com. There's a ton of educational videos and more stuff that we did on day trading and swing trading on our YouTube channel, and there's the link for that. You could just type in Briefing TV, and you can see a bunch of videos there. And if you like what you see and you'd like some more of these real-time trading opportunities, take a free trial of our service, Briefing Trader. You can contact sales@briefing.com, or you can give us a ring, 312-670-4463. And that about wraps the whole thing up. So thanks for attending. Appreciate your patience. Thank you.